Good afternoon, everybody. Welcome to TraderMerlin Show. It is Monday, the 27th of February. Thank you, guys. Anyway, let's talk about the natural gas. I hate cursing, but holy crap. Of course, I was joking on Wednesday when I was like, yeah, you guys, now's the time to buy because I got stopped out, if you will, on my natural gas, and boom, that thing just shot to the moon. Let's just look at natural gas to start the day because I think that was just a pretty damn funny trade. Of course, it's funny for me because I'm out of it. Didn't get to capitalize on that natural gas move, which is up 6.71% today alone. Goodness gracious. So here is your natural gas chart, and you guys can see where I got stopped out. I got stopped out right at the opening of this candle right here, which was about 220 for UNG, and this thing is just gone absolutely gangbusters. Just for fun, let's go see what Boyle has done since I exited the trade. So I exited on the day here on that open. It's rallied from where I got out 37.74% in just 4 trading sessions. Gotta love that. Pretty impressive swing there for Boyle. Is it going to continue? That's a question I've gotten from about 3 different people. Heck if I know. When this initial part was happening right here on this chart, I was expecting there would be a bounce. I thought we'd get up higher than 7, maybe get up to that 850 mark, and it didn't. It actually just broke down below, stopped me out, and now the question is, are we going to revisit that one again? Now, I'm not going to jump back into natural gas just because I got burned on that one last week. I don't really want to step back into the fray because I'll probably have a little emotional bias to that one. But right now, sitting right in the middle of that yellow zone, which was consolidation and choppiness for the early part of February, broke down below it. Now we're back dead center of it. So interesting trading week for natural gas, to say the least. Would you repeat your schedule for this week? Difficult to follow with the echo? Sure, no problem, Miles. And thank you guys for letting me know about the echo. Short it. I'm not touching it, Big Ab. I'm not touching it. Not right now. I am not going to do a show tomorrow. I want to, but I think it would be kind of odd if I just set up my broadcasting system in the restroom, because that's pretty much where I'm going to need to be. So no show Tuesday, no show Wednesday. I will do shows Thursday, Friday. Some of you have asked me about bringing Bob Dunn on the program, and I had a nice conversation with Bob over the weekend as I was driving back from Northern California, where I had just a great time snowboarding. It was beautiful, not beautiful weather, but beautiful snow. And Bob will be on, not this week, but next week. We're going to have Bob Dunn on the program. I know that's an exciting one for many of you. Bob will be always an entertaining guest on the program, and I'll work on getting some more guests on the show. So that was to start things off, just kind of the weird run that Boyle has had. Of course, I would totally have loved to have the gains, because right now I'd be in a pretty nice positive position, but instead I took a pretty sizable loss. But it's all right. It is what trading is all about. We can't dwell on it, move on to the next trade. So let me go into the topic du jour. We talk about, especially if you have taken a presentation with Darren Komodo of Online Trading Academy, he does a really good job of explaining what we call the everything bubble, where you've got the bond market bubble, the equity market bubble, the housing market bubble, hell, even the cryptocurrency bubble, all this kind of artificial inflation that the Fed has done. And that's been a big catalyst for this housing market as well. Certainly when those interest rates were down near zero, getting a 30-year fixed rate mortgage for 2.5%, man, people are buying up homes left and right. Now all of a sudden we see rates at 7%, and all of a sudden starts to slow down. We saw pending home sales, existing home sales, new home sales, all sliding. But then going back into the tail end of last year, we started to see the 10-year bond peak, started to sell off a little bit. And the talk track that we had mentioned a little bit was, hey, you know what? I wonder if we're going to start to see the housing market kick back up again. And that is the topic du jour, which will be a brief one, which is called Inflating the Housing Bubble. And I should have put re-inflating, because I really feel like this has been pumped up by cheap interest rates, but now all of a sudden we're going to see it potentially surge again. So here's the data that came out today from Forex Factory, and we could run through some of the other numbers, but let's focus on the top one here, which is U.S. pending home sales. And you can see they're expected to go from 1.1% growth to 0.9%. Now, obviously, anything above zero is a positive sign, right? You want to see the economy growing. You want to see things, more sales, obviously drive prices up in the long run. So for those of us who own homes, this is good news. Now you have pending home sales came out at 8.1%. Here's a chart of it. And, you look back historically, there were some outliers. And I would say that this whole little blip here in 2020, kind of the mid 2020, I almost want to just remove that whole thing from all of my data because it just skews it all. Well, right now you have 8.1% increase in pending home sales, which is arguably the highest that we've seen in a few years. I think we did peak right around the same numbers in 2021 a few times, but this is all pretty darn good for the housing market because it's showing you a surge coming in. Now, again, people want to know why that's happening. To me, it makes simple sense. It's not hard to figure that one out. We can go over here and look at the 10-year real quick, and if you notice, so that the chart we saw there for pending home sales, this one over here, this is a monthly chart. What I'll do is I'll change the 10-year to a monthly, and now we can take another peek at this one. So here is your monthly chart of it, and you can see it's been on this an unbelievable run up, but we've had this 1, 2, 3, 4 month period where we've had a pullback in rates. At one point, the high for the 10-year was 4.33, and we hit a low just recently of 3.84. So that pullback, I think, has been a major catalyst in spurring this pending home sales surge. So let me go back over here to pending home sales, and you can see that really for the last 1, 2, 3, 4, 5 months, you've had a big surge in pending home sales. And that coincides nicely with this 4 to 5 month sell-off that we see in that 10-year. Now, the question that kind of comes into play right now is this 1 point data? Do we look at that pending home sales and say, okay, here we go, it's a reinflation of the market to the upside, and we're going to see big price increases? Or are we going to see this just peter out, stop at 8.1, and then start to reverse back to the downside? And I guess that's a question I would pose for you guys is, what are your thoughts on it? You know, you see this number, and actually not just the number, but notice that trend over the past, we'll call it 5 months. On the hard red edge of that chart have been great. You've seen things start to increase significantly. It's looking really good from negative 10% to almost positive 10%. It looks good. However, I question it. I don't know if I think this is going to continue much higher. I actually personally think that this is the peak for it. I don't think that the next month reading will be higher than this. And again, this is just my opinion. You can totally disagree. And if you disagree, please type in the chat. I'd love to hear why you think this will continue to go on up. It'd be interesting to look at the moving average instead of 1 point. Yeah, unfortunately on this one, Tom, I can't put a moving average on this chart specifically. So Big F says inflation is going back up. Have you got gas, Lee? Have I got gas? I just drove 1,000 miles. 1,000 miles to Northern California. So yes, I did get that gas, and it has definitely gotten higher. But what are some other factors here? So you've obviously have this, you know, nice surge in pending home sales, which of course is great for anybody who wants a bullish market. However, we have also seen this 10-year rally back up significantly. And the question for me that I have to answer, and again, I'm just speaking out loud here to engage in conversation, is if that 10-year gets back up to that 4.335 mark that we saw back in October of last year, then I personally think you're going to start to see these pending home sale numbers start to decline. As Naum says, downside, I agree. I think there's more downside potential there because you're hearing just so much talk track about the Fed continuing to raise that short end of that yield curve, right? They keep raising that short end, it's going to just increase those rates and make it even harder. As I mentioned to you, I was doing a class on Wednesday nights where I'm teaching basics of finance and economics and personal investing. And man, the interest rate difference, if you had a 30-year fixed rate mortgage and you locked in at 2.5% on a $300,000 loan, that's an $1,100 a month payment. Same loan, same duration, but jump it to 5% now, you jump to almost $1,700. Same rate, same loan amount of $300,000, and you jump it to a 7% loan, you're at almost $2,000. So you've almost doubled your payment if you go from 2.5% to roughly 7.5%. And a lot of people can get priced out of those markets. So this 10-year is going to continue to put pressure on those numbers for housing. But it is interesting to see how quickly those housing numbers have switched, the pending home sales. Now, the other piece here to tie into this, and this may be a factor as to why you're seeing such good pending home sales numbers, look at the decline we've had in the Case-Shiller Composite 20 Home Price Index. So for those who may not know, the S&P Case-Shiller Index is a measurement of 20 major metropolitan areas of the U.S. and looking at the month over month or year over year price increases. Now, this was up around 21%. We're seeing year over year increase. All of a sudden, in about 8 months, we're now down to 6.8. Now, how does that stack up historically? Well, let's go all the way back into 2007, and you can see that for most of 2015 all the way through to, let's call it 2020, you could argue that right around 5, maybe 4.5% was the average there. So it looks to me like we still have a bit of space to fall here on a home price appreciation, right? What are those houses, how quickly are those houses appreciating? And I think maybe that's part of the reason why you're seeing pending home sales surge is a lot of people feeling that there's some good deals out there. But again, I think it's going to go down further. Now, if we do see this go down further, obviously the impacts for the markets are going to be layoffs. And of course, we'll have to wait and see how that all pans out. But I thought it was very interesting. It looks to me like it's a reinflation of the bubble because obviously when you have all these home sales coming in, 8.1% versus what do they think was going to be 0.9%, that's a huge increase, which means more demand for properties, taking advantage of maybe slightly lower loans, but how long that will last is anybody's guess. Other pieces that I thought were interesting. If you look at the durable goods orders, there's two measurements of durable goods orders that come out once a month, right? You have the durable goods orders, which are items that last 3 years or more. So these are like definitely not relationships. We're looking at cell phones, refrigerators, microwaves, TVs, kind of heavy duty items. With that durable goods orders, there's also a core durable goods orders, which takes out transportation items such as planes, ships, and trains. When you look at those two side by side, it gives you an idea of kind of where the spending is going. And I wanted to show you guys this chart here real quick because this is a pretty significant departure from the norm. Let me hopefully draw this without moving the slides. You guys can see here, durable goods orders dropped negative 0.45%. That's pretty bad. The previous number here was 5.1%, which means there's big consumption, and maybe that has to do with the holidays, but big consumption of durable goods, again, big ticket items the last 3 years or more. Well, they kind of forecasted a big decline here, going negative 3.7. Well, we came out much worse than that, so that would be a big negative on the day for the markets because obviously you want to see durable goods orders numbers increasing, not decreasing, because it reflects consumption. However, the number above it, this 0.0 or 0.7, that's when you take out all those factors I just mentioned, planes, ships, and trains. So when you remove the big ticket items, durable goods orders wasn't actually that bad. We actually showed growth, which means electronics are most likely doing well. But I have to, the way my brain works is I'm now looking at it from the other perspective. If you take out planes, trains, and automobiles, or planes, ships, and trains, and those numbers are absolutely atrocious, that means that nobody's buying planes, nobody's buying ships, and nobody's buying trains, which is a sign of, what would you guys say if I said, in a normal given environment, you had all of a sudden a significant decline in the amount of airplanes that were purchased, the amount of trains that were purchased, and the amount of boats that were purchased. What would you say would be your hypothesis about the economy going forward? Should be pretty easy one for you guys, right? If people aren't buying the big ticket items, right, you're buying a plane because people are moving all over the place and they've got money. Well, plane sales are declining. You're buying trains because you need to ship a lot of stuff all over the place and transport goods and services, or transport goods, not buying trains. And you need to buy, what's the final one? Planes, ships, and trains. Yeah, got them all. So to me, this is a pretty bad sign. This is, that durable goods order was a pretty big negative because it's showing that when you take out those planes, the economy is still growing, but there's a huge decline in the amount of consumption. Excess shipping capacity is slowing down right now, and that's where I was going with it. Right, it's starting to look a little bit. It's just missing John Candy. Oh man, let's not forget Steve Martin. Okay, it was a yin and yang there. You got to have Steve Martin and John Candy. But anyway, I wanted to bring that one up because I think a lot of people just hear the number and they go, "Oh yeah, durable goods orders were down today." But what does that mean? If all of a sudden those numbers start to get worse and worse for core, or for the regular durable goods numbers, that's a sign that things are slowing down. And again, I'm not trying to paint a case to make it very bearish or very bullish. It's just presenting those facts and we can formulate our strategy around it. I mean, I can come up with arguments as to why these markets may be bullish as well, but the data released today, I'm getting conflicting signs. The home sales said, hey, things look pretty good. People are buying and spending money. Durable goods order says, future doesn't look so good because the big items, planes, trains, and ships are declining. So not very good. Planes, trains, and auto are made in the U.S., including import brand electronics and other gadgets come from overseas. So this is probably worse than it looks. Maybe. Yeah, that's a good point. It might be a good thing because we're not buying overseas manufacturing goods. I don't know that. I just know that if I'm a business in the States, regardless of where I get my planes, ships, or trains from, if I'm not buying more, then that's a sign that I feel as a business owner that the future of my business that involves those assets and those transportation items is not looking as good. So I'm going to hold off. Again, supporting the recession argument that a lot of people have come up with. So Anyway, those are kind of the two main pieces I wanted to share with you to start off today's show. Yeah, I threw that out there as a joke, Gary, just to have a little bit of fun. Let's go and look through our markets for today, just to kind of see what happened out there, and of course, anything that you guys want to discuss, I'd be happy to. JB says, airplane ship manufacturers have 2 to 3 years of backlog, so how is it that they are shrinking? Well, maybe, and that's a good point, JB, and I can't verify that fact. I don't know that if that's true or not. I'm going to assume that it is. Trust but verify. But let's just say that it is. Let's say that right now manufacturers are totally backlogged, right? So you got Boeing and Southern Pacific all backlogged for manufacturing these transportation items. Then how can you have demand decreasing right now? Maybe those businesses that would utilize those goods. So let's say, I'm UPS and I need to, or I'm FedEx. I need to buy some new cargo planes to ship. If I, in fact, have a lot more demand, then yeah, I need some more airplanes or trains or whatever. However, maybe I already bought those, right? And this is where you get that 1 point data that can kind of throw you off here a little bit. Was it that maybe they bought last month or the month before, and now just collectively as transportation group, they don't need those assets? That could be part of it, JB, that they maybe already purchased. If we go look at the durable goods orders again, let's go look historically. Notice there's your durable goods orders of negative 4.5. But notice how here we had durable goods orders of 5.0 the previous month. So maybe, to validate your point, maybe last month is when they bought them all in January, and now they don't need to buy anymore, right? They may already placed their orders. The companies are backlogged. So again, it looks bad on paper at surface level, but you're right. I think you'd have to dig deeper into it and see, maybe they all just bought everything they needed last month. So we'll have to wait to see another couple months of this, I think, is the real proof is in the pudding, if you will. So while this one is disturbing to me and kind of shocking to see it that far off, I really want to wait and see what next month holds. So in March, we'll have the same conversation and see if this trend continues. Because if we do see further contraction in the durable goods orders like this, especially the core, then I think the story is painting a much darker picture for the markets going forward. Just at a high level. Let me go to the chart of the regular one. So here's your core durable goods. This is when you take out those transportation items. It looks fairly decent, right? Actually a nice pop, whereas it looks like we've been trending down for month after month after month after month. All right, let's go to markets. So we start at the top 7, work our way from the bottom to the top, maybe talk about some of the other markets that are moving out there as well. I won't spend too much time with crypto. We can talk about crude oil to start here. Not much has changed. I would say the song remains the same for crude oil, which on this daily chart here is still stuck in that gigantic yellow box that we have that goes from right around $70 up to $83, so a $13 range, but just oscillating back and forth between it. No real breakout inside or trend change, at least what I'm looking at here. So yawn fest for crude oil, which was down 0.84% today. Now, surprisingly, we have indexes kind of almost bookending our top 7 here. Here is your YM, which has come right down to the lower end of that range. We talked about that last week on how we'll probably challenge that lower end. If we break it, get a close below it, I would feel inclined to believe we're going to see more downside move. Now, here's where all of you have to just do things your own way, right? It was like, you can do it your way. That yellow box that I drew, what I did is I went through the real bodies right here. I kind of prefer that, but some people may have gone through the tails. Now, if I went through the real bodies, as I did here, right there, this low from December 20th, we closed below it. So right away, my mindset should now be bearish for this Dow because we finally broke it down below the lower end of that range. However, depending on who draws these pictures, which is why technical analysis is so much more art than science, I might be able to go to the very dead low here, which is the low from December 20th as well, which on the Dow was a low of 32,686. And we broke that on Friday's session. Now, we broke it, but we didn't close below it. So I modified this one. I'll leave it there. And again, what do you guys do? Let me ask you, would you use the tails or would you use the real bodies on charts like this? It's totally a matter of personal preference. I usually go by most points of contact to be number 1. You can see over here how I drew the top of that yellow box. You have these 2 candles here from November 30th and December 1st, and then it goes right through and hits the tail from December 14th. But notice I've completely ignored this long tail from December 13th. So again, much more art than science. I'm going to, tweak things to fit the story. So I've moved this to the lower end of that range in the YM, but I'm still feeling bearish on it. I think that it If it gets a close below that yellow box, then more downside movement. My guess is you'll probably see 31.8 is your next target. And there we go. I got tails. I got 2 tails and a body. Yeah, and again, it's just personal preference. For me, I would say most points of contact. Lisa says it depends on the size of the bodies and tails. Good, yep. Seems like using tails is more conservative. Correct. JB, if I'm using these tails, look what happens to the range. Right, that's what my range now looks like if I use tails. Well, to me, that doesn't look like it fits the picture, right? So I want to try to snug it down to that picture, which to me goes right through those bodies right there. So that's kind of how I would do it. But again, it's all different. Body as tickers are just an approximation for the real world. They're fuzzy. Body, I got tails. As long as you're consistent with tops and bottoms. There you go, Mark. That's the true answer. True answer is stick to your guns, have your strategy in place, and if you're using bodies, stick to bodies. If you're using the tails, stick to tails. What I don't like about using the tails is just what you saw here on this Dow, right? You really have this sideways consolidation to one real long outlier that happened on December 13th. Well, it kind of skewed it all. Yes, if you go off the traditional thought that this area was supply and these orders have now erased and eaten away all of that supply, I would agree with you. However, it gets pushed back down and it still is respecting that area. So my mind is still going to respect it, even though that it has ripped through that overhead area of supply. So just different strokes for different folks. Either way, Dow slightly positive today, 0.25%, closing at 32,909 and looking bearish to me. If it gets down below and closes below the low of this range, which on the low of this candle here is 32,686, I'd be looking for more downside movement there. What's Tom say? I'm looking at bodies as they show the true range better, as tails or outliers love the Dow range now. Yeah, I'm totally with you. And this one I'm okay. I'm okay fudging this one at the bottom here as I just did because those tails hit spot on, dead on. The upper one is a little more difficult because you really have these 2 points of contact that go back into December. But I'll leave it like this. We'll leave it and see what happens. But I'm feeling more bearish on this by the day. If that gets a close below the lower end of that yellow box, look for some short activity. S&P 500. Another one that was slightly up on the day, but a completely different picture than what we saw with the Dow because that yellow box was A, much smaller, and B, S&P is definitely selling off outside of that box. Down, up 0.31% today, closing at 3,988, so a slight little green candle there, but it was up much more during the regular session and gave back most of those gains to close just slightly positive on the day. From a big picture perspective, though, it really doesn't change anything for me, right? It's difficult, honestly, at this point to say I'm bullish or I'm bearish. I can remove that yellow box. Let me get rid of this yellow box for us. And, you step back. If I look here, I'm bullish. And so for the podcasters out there, again, thank you for those that do listen to the podcast. I appreciate it. Good to see you, Thomasina. This chart right now reflects the S&P 500 going back to October of last year, 2022. And it's been on a nice uptrend, right? Higher highs, higher lows. Granted, we're seeing a nice sell-off right now from 4,200 all the way down to, call it 39.6. Not like a 240-point sell-off. However, it's still not technically making a new low, a pivot low. So I've got that 39.06 mark on the screen here in blue. That's kind of my target for this one. And if we get below that, then pessimism on my part is going to start to settle in a little bit more here and make me feel a little bit more bearish. But that's on this daily from just October. What if I switch it and now show you the daily going back to October of 2021? Now all of a sudden I've got this big downtrend going on. Yes, it did start to make a higher high, but still I don't feel as bullish on it based off this picture. So interesting how when you change your perspective, your opinions of what the trend is or that security is change, which is why I love looking at things on multiple time frames. And if we went out even further and let's say looked at a monthly, I'm bullish. Hard not to be bullish on that big chart there. But normally I don't like to look at monthlies. It's just too big of a time frame for me. Market is bullish above 38.7. Okay. I'm all right with that on SPY. Oops. So as long as it stays above that 38, I got 38.8 would kind of be my spot right there. If it stays above that, yeah, fine. If it gets below 38.8, start to get more bearish, obviously. If we get below these lows that happened back in December of last year, then, okay, now we're going to start to look for more downside movement. But it's making higher lows, and the trend looks good. There we go. All right, next up on our list of competitors for our podium, Russell, not quite to the podium today. Here is your daily for the Russell, which I've got this giant yellow box here, looking similar to the S&P, although I would say it looks like a little bit weaker overall. Up 0.39% on the day, 1,898. Gold, boy, and silver has been getting me today. Not today, but I'm long silver and selling calls against that one, but I'm pretty surprised at the slide on silver, which I will point out here in just a second. We do have the dollar dropping out there again as well, and I'll show you that here shortly. 0.43% gain for gold, which is your bronze metal. Looking at that picture, we talked about this bounce in this yellow box area of demand. So, all right, logically, a pullback to that should see a bounce. If it gets below it, then go short. Now the question remains, where do you see it going to? And you guys tell me, what do you think? I look at this gold chart here. We're currently sitting at 1824. But if I look to the left, I really don't see any areas where I'm like, that's a great demand zone. That looks really strong. And if I do, it's a long ways away from current levels. I could make the argument, let's just go out here and have some fun with some drawing tools because we have the time. You could make the argument that there is a demand zone that goes way back here. I'm going to put these on the chart and just leave them and see if these ultimately come into fruition. That's the one, but that one's already been tested. And then you have another one here, which I might actually trim this one down a bit. Yeah, let me tighten this up just a hair to fit my style, which is slightly different than what you guys may have learned. So, I look at that as kind of my next two big stops. I don't see anything that's great in between current price and, let's say, 17.15. It just doesn't look great to me. So I don't know. I'm not really sure what to think about gold here. I feel like you have this unfilled gap that goes all the way back into November of 2022. But other than that, what's going to keep gold moving to the upside? Let's see. So no takers? Nobody's got any targets on what gold's going to do? There we go, Margaret. Thank you. 1761. So you got 1761, which is closing that gap, right? You're looking at basically the origin of this gap, which that I could see that. Because gaps definitely reflect an imbalance between buyers and sellers. So sure, I could definitely see that one. That one says 1750. You're going slightly below that. I wouldn't say 1750 because if you see where my cursor is at, I don't see anything there that I would isolate and say that's a strong demand zone. Personally, for me, no. JB says 1590. Well, you're going way out there, huh? 1590. Are you talking because of this little tail that goes all the way back into 2020? Before we get to 1590 though, JB, I think you've got to, you can't ignore these other levels that happen here, particularly the three in yellow that I have on your screen right now. Actually, there's four, but there you go. Those are the next major stopping points for it, but it could certainly find something in this pocket that goes from November 15th all the way through, let's call it December 30th. But I like Margaret's origin of that gap could potentially be one as well. It's funny how you all have totally different numbers. So Les says 1760, which again would be right at the origin of that gap. So between now and the next area of demand, I would say 1760 is probably the only one that I would hang my hat on, or at least put any emphasis on and take a stab at it. The question is, what's going to stop this thing from falling? And ideally, that would be the dollar index, right? So the dollar index has been having this great run. Kind of interesting. Remember, we drew this bullish flag formation and we used the measuring object here. So you have this measuring object is the same height as the pole of the bullish flag. Now it broke. It's been doing pretty damn good. It looks like we may actually end up hitting our target on this thing, which is 106. And remember, the more that the dollar rallies, the more it's going to hurt gold and commodities. So if this dollar keeps on rallying, that should have a negative impact on gold. The dollar tanks, then gold should start to rally. So this current trend that we're seeing here in the dollar index is a pretty good factor as to why you're seeing gold sell off like this, right? The dollar's been getting stronger and stronger, which means more foreigners can buy less gold with their dollars. They have to convert and they don't get as much for it. All right, so that's your podium for bronze. Bitcoin, surprisingly making the fray today. After seeing some pretty nice gains over 25,000, that line has just been a very difficult line for Bitcoin to cross over here. Currently trading at 23,445. You may have heard a tweet that was from Gensler over the weekend, where Gary Gensler said, every cryptocurrency project other than Bitcoin is a security. And I was kind of surprised that we didn't see much more negativity out there. I kind of thought we'd see the crypto market sell off because of that, because ultimately, what does that mean? That means that if the SEC believes that all cryptos, other than Bitcoin, are securities, then now all of a sudden, every crypto project is going to have to file with the SEC, fill out all sorts of documentation, and make it past a bunch of different hurdles in order to be traded on the U.S. market. Certainly, it could be traded on foreign markets. That's no big deal. But to get the real demand and see prices increase, you kind of got to be listed in the U.S. We still are some of the biggest in the world with regards to. I converted all coins to Bitcoin. Wait, did you say, Rajesh, that you converted all your coins, or we should just convert all the coins that exist into Bitcoin? That would be pretty funny. Nice. Good for you, Rajesh. Oh, Gensler. Anyway, so that was your number 2, Bitcoin. Even though, you see a red candle today, it was, you got a red candle on that bad boy. It was still at 0.43%. And then your Victor, up 0.72%. You had NASDAQ moving up slightly, still relatively bearish. Similar picture to what we saw with that S&P 500, where you had it making some higher highs, all of a sudden starts to make a new low. Now the question is, similar to gold, where do we see it pull back to? Because these are kind of messy zones. I, for one, am targeting that 11,446 mark, which would be different if we look at the Qs, right? Which would be that demand zone I've got drawn out here, which is 273 to 277 on the triple Qs. There you go. Yeah, and Rajesh, you got some taxable event there, unfortunately. Make sure you... Oh, Ronald McDonald, the big clown. I know. And it really does surprise me because Gary Gensler is an intelligent man. He is a very smart guy, and he's a crypto fan. So just kind of strange why he seems to be going after this. But maybe it's a money grab. Who knows? Let's see. Let me go. I had a couple lists of questions here. Oops. There we go. So Dennis, he says, does GLD track the price of physical gold? I've always used GLD as a proxy for physical gold, but I'm not sure if that's a solid assumption. Yes, it's not 100%. I would say it's going to be 99%, right? In one way you can do that and just check is, let's go GLD. So here's gold on the, actually, let's go gold futures. So I'm going to go add on gold futures here. And now if you hit the plus sign, I'm going to add on GLD. And we could actually just hit enter. And if I zoom out here, you'll notice that it's pretty lockstep, right? It's pretty close. There will be slight differences between it. The ETF has fees associated with it. The futures products has rollover issues. So they're going to be pretty lockstep together as far as percentage gains. So yes, I would say GLD is a proxy for it, and I do believe that GLD, the ETF, let me delete this bad boy and go to GLD. Let's go GLD. So this is a gold trust, and I believe that in that trust they actually do hold physical gold. So there you go. What was your ES low point for the year? I actually didn't specify my low point for the year when we did our survey. I actually just put in, here's what I think is going to close out, and I can't remember, but it was pretty much unchanged for the year. I think you're going to have a lot of chop, good volatility, but ultimately have a market that really didn't move much at the end of the year. So I thought that Q1 was going to be rather bullish, Q2 slowing down, Q3 and Q4 sell off. That was what I thought. Even stablecoins, though, expectation of a profit. Yeah, that's the weird one, right? The stable coins should not be passing the Howey test. And again, for those that don't know, the Howey test looks at 4 criteria in order to qualify as a security, and they're now saying that stable coins are securities, and it's like, well, there's no reasonable expectation of a profit, which is one of the criteria for the Howey test. So there's a lot of gray area with regards to what's going on in the crypto space. That's for damn sure, and hopefully we'll get the clarity this year because it drives me nuts. Anyway, Dennis, there was your answer there. Ed in San Jose, one of the regulars here who never joins us live, but he always listens to the podcast, and I'm assuming he listens to the podcast right around 5 p.m. every day, because if I don't post the show by 5:01, Ed sends me an email. Where's that podcast? So thank you, Ed, for your continued support. I find it hard to believe that people can listen to podcasts and not see the visuals. I always forget that I've got people that just hear this stuff. So thank you for doing that one, Ed, and I always appreciate your feedback. Whether it's positive or negative, it's always good. You're always helpful. So I'm not a registered investment advisor or broker, but I think I can answer this one. Ed says, if a person is concerned that their shares are being borrowed and shorted, wouldn't it be easier to take the account off margin? Then I think the shares can't be shorted. No. Basically, your shares still become part of the pool for that brokerage firm, regardless whether it's a cash account or a margin account. The margin applies to you. So if you're in a cash account, you can't short your shares, right? You can't go short. However, those assets are all pooled together with everyone, and I'm pretty sure that, let's say you had 1,000 shares of Apple, and that's all you had in a retirement account, and you said, hey, it's a retirement account, you can't touch it because it's a cash account, right? A retirement account's a cash account. You can't do that. So, to me, I'm pretty sure that if you said, I don't want margin, they're still able to borrow your shares, which is why, I found that show last week rather interesting with regards to who really has ownership of your shares. Whatever you deposit in your brokerage firm, they may, here's my bitter cynic view of it. I believe that a lot of them are doing many things they're not supposed to be doing anyway. Like, for example, how did we get 140% of all of GameStop's shares short? That means that someone borrowed every single share available in the world, which is not mathematically possible because there's shares at so many different brokerage firms. How could you possibly get access to every share and short not only all of them, but 40% more than existed? That tells you something fraudulent's going on behind the scenes. So I don't trust the brokerage firms anyway. I believe they're shorting out of thin air, right? Naked shorting and just making it up as they go along. So I don't think it makes a difference, Ed, whether you say at margin account or cash account, they're still going to borrow those shares, put them in a big omnibus account, and that is part of their AUM, assets under management. And from that, they'll be able to borrow and lend out those shares. Has there ever been a massive case of shares being loaned out by a broker and lost? Not that I know of. I only know like that big issue that happened with Dole and the DTCC, right? That was a huge, like, how did they misplace like 10 million shares? It was just nuts. But I don't follow that stuff too closely with regards to, has any firm lost? Most likely they wouldn't lose, Tom, because what they would do is, if their inventory starts to run low, they'll automatically call back the short, right? So again, I think I made the example. Let's say a firm has 5,000 shares of Microsoft for the whole firm. Let's call it E-Trade. They got 5,000 shares of Microsoft. If you go to borrow that, they're probably going to go, sorry, we don't have enough. But if they got 1 million shares of Microsoft, yeah, you can borrow 1,000. There's probably some algorithm that says X amount can be loaned out from our assets under management. But if that pool starts to dry up, let's say customers start selling those shares, at a certain point, they will call back those shares from you. And remember, they can call back your short at any time without notice. They can just, boom, they took the shares away from you. So maybe I short 140%, 200% of the time. 97% of statistics are made up. Anyway, that was that one from Big Ab. And then Tim, I always love when you guys send in penny stocks or just wild things. Tim says, thoughts on AAMC. I actually thought you meant AMC, but then I looked at the chart. So I went AMC, which was crazy today, up 22%. And AAMC, even better, 25.6% today for this one. So you look at something like Altisource Assets Management Company. This sounds like something that's completely manipulated. Totally manipulated, because look at the history of this thing. This thing, going back into June of last year, was a $9, $10 stock, and now all of a sudden it's $56. You look at the volume on it, and it almost looks like someone has just been triggering internal buying. So you just start buying $10,000 worth a day, 10 grand, and it starts to create these big uptrends. And they most likely, this is what, earnings tomorrow? So the earnings are actually supposed to come out on March 23rd. So that's their earnings announcement expectation. Let's say they have a news announcement today. Repurchase common stock. So they're buying their shares back. Smart move. This is the way you inflate your share price easily. So as far as thoughts on this one, Tim, I don't really care. Sorry. It's very illiquid. Trades 30 to 20,000 shares a day. So it's already long off my list. In a situation like this, there's only one way. And let's see if you guys can figure it out. If I was to look at this chart right here, there's a couple different things that would make me go, I am looking forward to trading this one. What would you guys think it would be? Right? If I showed you this chart and went, oh man, I am ready to short this, I will load the boat on it. What criteria do you think I would have to see on that chart to make that statement on this AAMC? Well, number one would be, is it coming back into a supply zone, right? So we can look out here, and it actually looks like it ripped through one. All right, so here's your current price of what, $52. It looks like it. So I wouldn't really call this. I would have actually thought $50 would have been a more supply zone kind of place to go short, but it knifed through that one. The other piece that would have drawn me to this one is if I had normal volume, right? Like let's say it's trading an average of 1 million or 2 million a day, and then all of a sudden it had like a 20 million volume day, climactic volume, right? Check volume, as Pepe says. So curve, okay, curve is fine. Kind of just saying, you know, where are you located and kind of how does the whole picture look. This just looks way overextended. I'd like to see climactic volume, but I can't touch this because of the volume. It's just, there's just no way that this would ever be appealing. Even just joking around with 1 or 2 shares, I wouldn't do it because of the liquidity. You're not going to get a good fill here. Isn't volume questionable? You mean overall on everything, JB? Like, should we question the validity of volume? Sure. On this one, again, the volume is visible and it's just so low that there's just no way I would touch this thing. Because I mean, I'm not going to trade with 10 shares or 100 shares. I'm going to need, give me 1,000 shares of it or something. I need volume, and that liquidity could really just kill me on this one. So there you go, Tim. That's my thoughts on AAMC. Personally, not going to touch it. I don't think it's worth going. Margaret says long 37.77. So you're looking right in this area of consolidation. I wouldn't touch it. I personally would not touch this thing at all. It's just risk management, right? I mean, we have over 6,000 different stocks you can choose from. 6,000 different companies you could choose from, and this is the one you want to go with that has super low volume and looks manipulated right now? Forget it. Go with something that has... If this had incredibly high liquidity, I might think about it. But it's just not worth the risk, Margaret. Why put yourself in a situation where you could get absolutely smoked by a low liquidity trade? Because it's not going to take a lot for this thing to move. Look how much it moved today. It's up 25%, and it traded 60,000 shares today. 60,000 shares. I mean, I had 10,000 shares of Boyle. I do a market order on Boyle in a market like this. I'm going to drop it 20%. It's nuts. Good question for Tim Sykes. Tim Sykes. Yeah, that guy. There's another interesting dude. Oh man. All right, I think that was it for my questions. Let me show you what's happening out there tomorrow. Then I'm going to wrap this thing up here and then go eat a nice, big, wholesome meal and get ready for tomorrow's prep. The prep is the worst part. All right, earnings for tomorrow. So you've got Cronus Labs, which, of course, is in the cannabis area. That is coming out before market open, but it's a really small cap, and a lot of times they report late. They just seem to be always moving the goalpost, if you will, on their earnings announcement. You've got Target, Bank of Montreal, AutoZone are the big names. You've also got Novavax, Advanced Auto Parts, HP, Ross Stores, and Urban Outfitters. The reason I bring this up is there are a lot of retail companies reporting earnings tomorrow. A lot of retail companies reporting earnings tomorrow. So it'd be interesting to get a picture as to what is going on with regards to consumption. Of course, Target is one of the biggies out there, so that'll be an interesting one to watch. That's before market open. Almost all of these are before market open. A couple of the retailers like Ross, Hewlett Packard, and Urban Outfitters coming out after market close. And lastly, you thought we had some good news out there, economic data today. Tomorrow, it's going to get even better. We talked about that Case-Shiller Composite 20 Home Price Index, having fallen from 21.8 to 6.8. They're expecting it to fall even further, 4.7, meaning it's just going lower and lower and lower and lower with regards to year-over-year gains for the housing market. So clearly a sign things are slowing down, which is kind of why I did that topic today, talking about the housing market bubble and inflating it. Right? As these prices get lower, it becomes more attractive to potential buyers out there. And as long as those interest rates remain low, there might be more buying going on. So you have goods trade balance, preliminary wholesale inventories, HPI, and Case-Shiller Composite 20 Home Price Index number. So you have 2 housing data points. Those are all coming out before the market opens. You have Chicago PMI, Consumer Confidence, Richmond Manufacturing Index, and that's it for the U.S. Now, I do have China stuff on here. I normally never keep that on, but there's your China data. Early on in the morning for our neighbors to the north, you do have GDP. That'll be an hour before the markets open. And that is your economic calendar, your earnings calendar, etc. for tomorrow. Can you really discuss how market cap influences stock price, if it does so in any way? Well, yeah, I think it does impact the security, right? Market cap. Well, one thing that you have to pay attention to is not just the price. A lot of people look at the price of a security and go, oh, it's a penny stock, it's trash. That's not the good measure, really. You want to look at how many shares are available, number one, and what the price of that security is. That's what makes up your market capitalization. Now, typically, when you have a big market capitalization, it means that you're one of the more established, better companies out there. So I like to look at it because it generally tells me if it's a big company, normally a big company will have liquidity and activity in it because people are interested in trading that security. So that's the only way I look at it influencing a stock is more of its acceptance. If something has a very small market capitalization, it's going to be extremely volatile. Let me go back to our picture here. So you can see the market cap, Cronus Labs, right? CRON. This is a fairly thinly traded one. It's one of the more popular cannabis stocks, right? Cronus Labs trades roughly, about 1.5 million? Yeah, 1 point here. I'll show you the chart. 1.2 million shares per day. However, its market cap's very low, and it's a cheap stock. So this thing's going to be extremely volatile. Now, it does have some decent liquidity. At least it's over 1 million, right? But very low. Penny stocks, thinly traded, could be very easily manipulated. Look at TGT. Right here, you got something that got a more substantial price, trading $166. Now, its averaging looks to be around, about 2.5 million shares traded per day. So you have more liquidity with that one. Now, don't get me wrong, a high price doesn't mean it's more liquid. You want to look at the share price as well as the liquidity of it, and a lot of it has to do with the float and outstanding shares. So, these ones down here that typically have these really slow volumes like AMC or Novavax, right? $712 million market cap. I'm probably not going to trade it. I may buy it, but I'm not going to trade it. Something like Ross Stores, right? You got a $38 billion market cap. Okay, I'm interested in that one because it's a more substantial company. Let's look at those two real quick. We'll look at Ross Stores and Urban Outfitters, just as a Pepsi challenge here for you. Here's Ross Stores. Pretty boring chart, actually. This is a Tom Bar chart. Looks like it's just been going sideways here. Anyway, volume down at the bottom, so it's trading, looks to be about 2 million a day, so that's fine, that's great, and the price is fine, so there's plenty of room to be going long and short on this one, and it has decent liquidity, and it has a monster gap. Boy, look at this gap on Ross Stores, based off their last earnings, it has not even come close to it, so keep your eye on that 97.90 if the thing has a breakdown tomorrow. And then let's go look at Urban, URBN. Remember, Urban Outfitters has a much smaller market cap. It's like less than 1/10 of Ross Stores. So notice it's trading less than right around 1 million shares would be its average, I would say. Price-wise, $27. So okay, fine. But you have decent liquidity. So that's really all I'd be looking for. The Urban Outfitters fund. Boring. Just your charts, Tom. You are by no means a boring guy. Just your charts. You like the boring sideways ones. That boring equals money to you. How was my financial class with friends? Great. It really is great. It's awesome to see people's eyes just light up and like, oh my goodness, like, wow. I didn't know that. I wasn't thinking it. And just seeing them make immediate changes to what they do, that makes me feel pretty good. So I was supposed to do another session on Wednesday, but I have a feeling I'm going to have to cancel my session on Wednesday just given what's my procedure's gonna be going on, but I'll start those back up next week. And I'm making notes to it all because I may actually just I don't know. They're actually pushing me to just do my own class like that, just on personal investing and financial planning, and maybe I'll do it at some point. I'm expecting maybe. NJ, with your HL, what are you asking about the Hecla mining? Is that what you're looking at? I don't know the symbol HL, or unless it's high-low, which is typically I would know it to be. All right, I'll just look at HL chart here because NJ, always a good contributor. Price-wise, chart-wise, look, I don't know nothing about this, so I don't know whether crypto mining or actually mineral mining or gold mining or copper. I have no idea. Chart-wise, it looks to me like you're just headed down on this bad boy. You got this nice pullback. I don't really see any really strong areas of demand anywhere on here. There's nothing. Oh, there's a couple that are a little bit lower, but again, this is another one where the price isn't really giving me any great clues. So I would probably just move away. We still have to meet for lunch, Pepe, or have a drink somewhere. That's first on it, but I'm not inviting you guys over to my living room. Not yet. All right, that's going to do it for me, everybody. If you guys enjoyed today's show, do me a favor, hit that thumbs up button, which I know a lot of you do. If you guys are new, which I think all of you are regulars out there, hit that subscribe button. I will not be doing a show tomorrow. I will not be doing a show on Wednesday. I will be doing shows Thursday, Friday, and from pretty much here on out. I think I'm actually teaching a focus series in a couple of weeks for OTA, so I'll have to take, I think, one day off for that. But either way, I will see you guys on Thursday. Hope you all have some fun trading out there. We got the economic calendar and earnings all covered for the tomorrow already. So take care, everybody. Sorry to keep shorter weeks for you, but got to do what we got to do. I will see you guys on Thursday. Take care.